Congress just passed this big, beautiful bill here recently, and President Trump signed it on the 4th of July. And the White House is saying that for retirees, 88% are not going to have to pay any taxes on their Social Security. And even more importantly, the very best option that we have to defer taxes on capital gains and potentially eliminate taxes on capital gains has just become permanent. So there's a lot of controversy in this bill. It cost a lot, they say, and it was over 900 pages. And we want to get into some of the key provisions of this. But before I do that, my name is Joe Franklin. I'm a certified financial planner. And here at the Mustard Seed, we're all about putting finances and faith together. And we care more about what the source says, the word, than what ChatGPT says. But in this case, the source is the tax code and what's just been put into law. I'm kind of in the same camp as a lot of people like Ray Dalio and Warren Buffett and Elon Musk and Jamie Dimon, and all those people are saying that we can't afford to keep spending like we're spending, but we've also got to be practical. And so when we're practical, we got to realize that Washington works a little bit differently, and in order to get some things passed, you have to put up with a lot of other things. And in passing this bill, you had to get the vote of the Alaskan senator who wanted to be able to allow for a $50,000 deduction for whaling equipment. And so they have all this pork in this bill, but we have to put up with it. And as Abraham Lincoln once said, the biggest threat to America is going to come from within. We've got the best system out there, but our system isn't perfect. We have to put up with a little bit of imperfections, although we've got probably the best systems of checks and balances out there to get what we want done. So last year we thought that all the 2017 tax cuts were going to expire and that we'd end up with higher taxes in 25 and later. But because of the makeup of Congress, we were able to pass this law to keep taxes down. And so I don't think there's anybody complaining about their taxes not going up. And with clients, we were advising to take more Roth conversions earlier on and move all your itemizations into the earlier year. A lot of times we like to bunch up the itemizations, so you're taking all your itemizations in one year and then switching over to the standard deduction the next. That itemization bunching can save a lot of tax. But we were trying to bunch everything into 2025 because we thought that taxes were going to go up in 2026. But of course, now with this law, taxes aren't going up. They're staying the same for the most part. In some areas, we're going to get a little bit of tax savings in addition. In some areas, we're going to lose a few things. But let's get into the particulars. And I want to get into the particulars primarily as it relates to retirees and how this can affect us from the time we're drawing Social Security and forward. One of the most controversial things that we've seen is a lot of people are saying there's been big cuts in Medicaid. And there's been about $800 billion cut from Medicaid. The primary thing they're wanting to do with Medicaid is make sure that people are working to be able to qualify for that. You have to have 80 hours a month in order to qualify for that. And you also have to prove residency twice a year. And so what they're just trying to make sure is that people aren't drawing Medicaid that aren't supposed to be drawing Medicaid. We want to make sure that our citizens are getting what they're supposed to get, but not people who don't even live in the U.S. So they've made these cuts to Medicaid. They've also made things with regard to student loans so that you can't take out more than a certain amount in student loans. They've capped that because they don't want people owing the government hundreds of thousands of dollars and not ever being able to pay it back and cause all this heartache in the future. We still want to be looking at doing Roth conversions because we don't know how long these taxes are going to last. Some people say they're permanent, but we all know when someone new is elected, they're going to try to pass new taxes as soon as someone new is elected. So we've likely got this until at least around 2028. We want to look at having fun now. Take your money out of your retirement now and have some fun because you can afford to spend more and show more income because you're not going to be taxed as much on that. And we want to look at possibly taking some tax harvesting now, sell some things and harvest the taxes now rather than waiting until after 2028 when it may be the taxes are higher. There's a lot of things we can do while taxes are down that we can't do as easily once the taxes go back up. If you're making over $1 million, then you're going to get about a 3% boost in your after-tax income. And what they did with the SALT deduction is they raised it up. It was at $10,000 and they raised it up to $40,000. Of course, in a lot of these states they had higher taxes, and so in these states you're able to get more of a deduction on your federal taxes. And of course that's also phased out. So if you make too much, I think in this case if it's over $500,000 you don't get that SALT deduction. They also extended the estate tax, but one of the biggest things that we've seen that we've been able to use for clients to help save them taxes, especially on things that they sold, like businesses or properties or stock with a lot of appreciation, we've been utilizing what's called opportunity zones. And with these opportunity zones, you buy the opportunity zone within 6 months after you sell something, and you can use it for just about anything. There's something called a 1031 exchange that you can use for real estate, and that's really good. Most accountants are familiar with the 1031 exchange. They're not as familiar with opportunity zones. We've been teaching a lot of accountants about this, but they're a lot like the 1031 exchanges in that you can buy things in the opportunity zone and not have to pay taxes on what you sold until you sell what's in the opportunity zone years down the road. The only thing about this is that you have to file it a little bit differently, and it can be used for anything. So it doesn't have to be just for property. It can be used for stock, and it can be used for a business. It can be used for anything. And so these have been really, really popular. They were set to expire at the end of 2026, and the new laws just made this permanent. And so this is a really, really great opportunity to utilize these zones to save taxes. Now, if you hold on to the opportunity zones for at least 5 years, you get a reduction in the taxes on what you sold originally. So if you hold it on for over 5 years, you get a 10% drop in what you have to pay taxes on, so that's great. They've also come out with these super opportunity zones. These are referred to as Qualified Rural Opportunity Funds, or QROFs. And with these, the fund has to be invested in a rural area, or you can invest this yourself in a rural area. And with these, you get a 30% drop in the taxes you have to pay because the basis gets bumped up by 30% with these. So these are new, and these come about. They're going to be allowable in 2027. Stay tuned for more on these. The old rules apply until 2027, and then we go into the new rules. So with the old rules, we still get that 10% bump by a certain date, and you're able to defer the taxes on things that you sell. So if you don't know about these, you want to learn more about these, then we'll have a link in the bottom. You can put some things for us on these. Under the old law, every person had $15,000 that they could deduct on their standard deduction. Of course, if you can itemize, you can do more than that. It's $30,000 married. That's been increased to $15,750 and $31,500. There's a bonus deduction for older adults. If you're over 65, that bonus deduction was $1,600. That's been increased to over $7,000 and $8,000 if you're not married. Yeah, and the child tax credit's gone up from $2,000 to $2,200 starting this year. They've also come out with these Trump retirement accounts that give you an extra $1,000 when you have a new kid. So you get this free money that you can put in the Trump retirement account. They limit what you can invest it in. It has to be invested in the U.S. It can't be invested overseas, so it's a little limited there. But why give up the free money if the government's giving it to you? There's also no taxes on tips up to $25,000. You can get overtime pay and not have to pay taxes on that, up to about $12,500. These sunset in 2028, however, so keep that in mind. You can deduct up to $10,000 in auto loan interest, and I think the average amount somebody spends on a car as far as interest is concerned is about $700 a month. So that's not quite the $10,000, so that may increase what people are paying for their cars a little bit on average. But the key thing with this is that with these autos, they have to be manufactured in the U.S. and it has to be for a new car. And this goes away in 2028. Don't think that you have to go out and get a new car just because you get a deduction, because the cheapest car you can get is the one that you already own, and it's much better to buy what you can afford and maybe buy something that's slightly used that's a whole lot less. It may be that you can save more by buying a used car than you can a new car. You're also getting a charitable deduction for everyone, even if you are already taking the standard deduction. So if you're getting the standard deduction and it's a $31,500 for a married couple, you can also take an extra $2,000 off your taxes if you give that to a charity. It's $1,000 per person. That's also included if you're itemizing as well, but this is new in that you've got this for people if you're taking the standard deduction also. So for a lot of people, we've been doing these qualified charitable distributions out of IRAs and not have to pay any taxes on that. So in addition to this, when what you taking out of your IRAs, you can take that extra $2,000 from anywhere and not have to pay taxes on that $2,000 that you're giving to charity or church or what have you. So there's also some good benefits for business owners. I want to touch on a couple of these. Bonus depreciation is at 100% again. You can depreciate 100% of equipment in the first year. We also want to note that if you are building a building, then manufacturing buildings can be completely written off in the first year based upon these rules. We may get into this a little bit more in a future video. And it may be that if you have a loss on the building, that you can still carry forward the losses on that over time. And one thing that we've noticed is there isn't anything in the bill with regard to the entertainment deduction. And it looks like the entertainment deduction is back. So they were limiting what we could spend on entertainment and deduct that from our taxes. So it looks like we're going to be able to spend on and entertain people once again, take people out for golfing and other things, and be able to deduct that. So that's great. Now, one thing I want to keep in mind when you're filling out your taxes or you turn these over to your accountants is there's going to be some extra requirements, especially with regard to these qualified opportunity zones. And we found that a lot of accountants don't know everything that they need to with regard to filing these because these have been new in the past few years. They've now been made permanent, so I think a lot more people are going to be using these. And they're actually a little bit better than 1031 exchanges in our opinion. But when you're filling these out, you got to fill them out correctly or there may be some penalties, so keep that in mind. If you're working with your accountant and you need them to call us, if you're already a client, you have them call us and we can help walk them through how to file this. We've helped some people do this with TurboTax here in the past. So one thing that I've been pretty vocal about is the fact that this bill costs a lot more than it needed to. The Senate version looks like it's going to cost about $3.3 trillion in new debt for the U.S. When we're spending this much money, it's going to drive up our debt. We've got this deficit and we've got a lot of interest we got to pay. And it's not good for our country to be spending so much irresponsibly. And in order to pay down the debt, there's one of three ways that we can end up paying down the debt. And one way is we can raise taxes. And maybe eventually we have to raise taxes. We can cut spending. And here recently we had one of the best opportunities to be able to cut spending and get back to a balanced budget like what we had in the 90s. But we haven't done it. We don't have that discipline right now in cutting spending. I'm not sure if we're going to get that discipline. And we could default on our debt, and defaulting on our debt isn't a good option. That's going to be really bad. We'd lose our reserve currency status if we did that. So I don't think we're going to want to do that. And the last thing we can do is we can print money and we can inflate our way out of it. We can try to grow out of it and inflate our way out of it. And that's probably what we're going to be doing. We've already seen the dollar continue to get weaker versus other currencies. That's probably going to continue. And that's not as good for investing in the U.S. It's better for investing overseas, but it may bring jobs to the U.S. So if we're inflating our way out of this problem and devaluing the dollar to get out of this problem, what's going to do well? Now, in a risk-off scenario like when we're going through a recession, most people like gold, and that's something you're probably going to want to invest in to preserve the value of what you got. Real estate's also good to invest in. If we're in more of a risk-on period where the market's a little frothy, usually it's Bitcoin that does better, and people see Bitcoin as a better option than gold because you don't have to lug it around and do other things with it. You can move it more easily and transact with it a lot more easily than gold bars and even coins. Some of these tax law changes may allow for other investment opportunities. They're spending over $300 billion on the border wall, and they're spending over $150 billion on drones and things of that nature. So defense stocks have already been doing well. Green energy's out, and nuclear energy is in, and of course drilling and other types of energy are also in, coal and what have you. So energy stocks may do better under the current tax laws as well. Of course, energy prices have come down, and so we haven't had that boom in energy yet. But with inflation, that may come about. We're likely to see more inflation, because how are we going to get out of this situation? Of course, Warren Buffett is not investing in long-term treasuries. He's investing in short-term paper. He thinks that inflation is going to be coming back. A lot of other people feel that inflation is going to be coming back, like Dalio and other really well-known investors. And so most likely, in order to get out of our situation, we got to make sure that we're invested to benefit from inflation. And some of these things like gold, Bitcoin, real estate, energy, commodities, other things like that are going to benefit from an inflationary economy. These new tax law changes can provide some opportunities for a lot of people, especially with these opportunity zones. If you have more questions about the opportunity zones, please feel free to reach out to us. If you have things you'd like us to share in future videos, put that in the comments below. But as always, we want to make sure that we have a plan. Work with a financial planner, preferably a certified financial planner that's a fee-only planner. Since you love these videos so much, please feel free to put those thumbs up, subscribe to the channel, and click that notification bell so you can be advised of new videos when they come out. And always stay thirsty for knowledge. We'll catch up with you next time.